So we talk so much about the core principles of quant trading, but what the heck does that even mean to us as traders? How do we apply that? That's what we're going to talk about on this episode of the Independent Quant, episode 7, the core principles of quant trading and how to apply them in a real world scenario. I'm your host and the founder of the Independent Quant, Luis. Welcome. As always, this podcast is for educational purposes only. No, I'm not a financial advisor. I'm not here to coach you through the markets or provide advice. For that, refer to professional, the proper professional guidance. So with that, let's jump right in. So the core principles of quantitative trading. We've talked about that over the course of the last 6 podcast episodes, and we said that it was the rule-based structure of quantitative trading. And again, when I use the phrase quantitative trading, I'm not limiting to just statistical trading strategies. I'm also talking on systematic trading strategies and specifically algorithmic trading strategies. So here at the Independent Quant, we look at quantitative trading for its algorithmic capabilities. So with that, we have the rule-based nature of quantitative trading because of its structure. Because it is so rule-based, we're able to make data-driven decisions based off of that information. And we can then backtest, manage our risk appropriately, and are able to gain efficiencies or exploit inefficiencies in the market. So that's all very high level. We're going to go step by step with one of those. And I'm actually going to share a strategy that backtesting currently and actually in the works of development. So I don't do this as a recommendation for any of you all. Like I said, this is something that I am working my way through. And I just thought that it would be a good example to see how to implement all these principles to just an actual working strategy. So rule-based nature. So we need to first find what's the purpose that we're trading for? What's the objective? For me, in this strategy was to have an intraday strategy that I could use, maybe with the hopes of Sunday running it and one of the prop firms' evaluation challenges and have it run and maybe get a funded account. So that was my approach when I started with this. So I said, all right, my objective is an intraday strategy. I need a strategy that is looking at a lower time frame because it has to play itself out over the course of a day. Both the entry and the exit have to be within those parameters. So I went with the typical moving average crossover. Now your standard moving average crossover, that is when a fast moving average crosses over or under a slower moving average. They're pretty good strategies except when they're not. And they're not when the market is not trending. If the market's going sideways and by the market I mean whatever symbol you're putting it on. This focus here is going to be on the S&P 500 futures or the symbol ES. If the symbol's going sideways and price is just choppy going up and down, those moving averages are going to be crossing back and forth, causing entry and exit positions constantly throughout the course of that trade. So that's okay. That's a start. So we say, all right, now we've got this moving average crossover, but I've got this flaw with this one condition where if the market's going sideways and not trending, I can't use this strategy. So how can I make sure that the market is trending to trigger an entry condition? One way I did that was I used 3 moving averages. So I tested that out. I said, okay, well, let's say if we have 3 moving averages, and now we're going to say testing it out. Let's stay in the rule-based nature of quant trading. Let's stay in that first kind of step. So I said, well, if I introduce a 3rd moving average to that, then maybe I can say, all right, you know what? If the fast moving average crosses over the slow moving average, let's say I've got a 5-8 and a 10, the 5 crosses over let's say the 10. Well, I only want to take that trade if it's the fast moving average is also above the medium because there is lag between those 3 moving averages. So if I say, hey, you know what? Maybe if when the crossover happens, we have all of them crossed over and showing a positive or a bullish market, then that should be a good signal to enter. I looked at a chart, just kind of eyeballed it to see how often that was, and it looked pretty good. But there was a lot of opportunities where it failed and it would still get into this choppiness because the 3 moving average just weren't quite enough. So to that I thought, well, how about adding a 4th indicator in there that isn't a moving average, at least not a moving average like those three, that is more reactive to what's happening and more reflective of what's happening in the market today. And that's where the VWAP crossed my mind, the volume weighted average price. That is a indicator that takes into account what the volume for the day up to that moment where it's calculating, or what the average price is. And it plots, and when it plots on a chart, it looks very similar to a moving average. However, it's not as sensitive to price movements as the moving averages I just mentioned, and it's more reflective of exactly what's happening in the market, because a market where you don't have much volume, that can be really bad for a typical moving average, because price can get really choppy and it can jump, several ticks or get a good move just because there isn't much volume in the market. So it looks volatile, and it is volatile, but it's really more because of lack of players in the market. So using those three moving averages with the VWAP, I think, okay, well, how about I think of this as my rules, is let's have the fast moving average when it crosses over the slowest moving average and prices above all moving averages, the fast, medium, and slow, and also above the VWAP, then I'm going to say that's an uptrend and that's an entry condition. Now, I can get real chopped out, so I'm thinking, well, how do I get out of this trade, right? I don't want to give too much money back, so that's what that middle moving average is for. I'm thinking, let's take that fast moving average, and when it crosses over or under the medium moving average, then that's my exit condition. And right there, we just walked through how quantitative trading, we're using technical signals, right? This is using technical analysis, but using a rules-based approach to figure out when my entries are and where my exits are. So there I am adhering to the first core principle of the quantitative trading. Now, the next one is data-driven decision making. So all of this is pretty much already ingrained because I'm using an indicator. So it is using market data that is happening right now to make the decisions to enter and exit. So I am very much using a data-driven approach, using the market data that's coming through. I'm not introducing myself into the mix. I'm not going to supervise this algorithm. I'm just going to let it work based only on what it's processing. So take that now. So I've got a set of rules that I just described to you. How do I know that they work? Well, that brings us to the third principle of quantitative trading, which is the ability to backtest. So I can code. I did this in NinjaTrader. This podcast is not sponsored by NinjaTrader, but I use NinjaTrader because that's my primary algorithmic trading platform. Coded it out in C#, gave all the rules just as I described them, and I backtested that. And okay, since this is going to be an intraday strategy, I didn't want to go too far back in time because markets day to day may not change as much, but they can change significantly week to week. Given that at the time of this recording, it is beginning of May of 2025, I really don't want to be looking at January or December data. I want to see how this intraday algorithm is has performed the last 3 or 4 weeks. So that's what I do. I go into NinjaTrader, put in the code for C#, and then I'm allowed to backtest that using NinjaTrader itself. And I found that it was a profitable strategy. So I said, okay, first off, it's a profitable strategy. Now I need to see what the risk parameters are. And I started looking at all the metrics that I've talked about in the other podcast episodes and on the Independent Quant website to see if this is a viable strategy and how much capital I would need to trade this strategy. And what I found is I had to iterate several times through this strategy to get it to the actual profitable state and really to get it to the risk parameters that worked for me. For example, I toyed with putting in stops, trailing stops, where if an entry happened, a stop would follow price as it moved up, so I wouldn't be giving back a lot of money. And I found that those had adverse effects. And what ultimately worked was simply just letting the moving averages do its thing. It opens and closes when the moving averages did what I just explained in step 1. But I knew that was the best choice because I had the ability to backtest multiple different types of scenarios where I altered the rules or the specifics or the parameters to get it to a point where I can have this work. So that's the beauty of backtesting. And the fourth principle I kind of wrapped up in there, which is risk management, which is, of course, capital. The protection of capital is more important than profit. I read that somewhere. And nothing can be further from the truth. The market can remain irrational longer than we can remain solvent. So we have to make sure that we are protecting our capital every step of the way. So through that back test, I'm keeping an eye on what the maximum drawdown is, what the average loss is. Average win is great, but the average loss is truly more important because it can have adverse effects on your trading. So you want to see the maximum number of losing trades, or the maximum number of consecutive losing trades, the maximum number of consecutive winning trades, because that will tell me, hey, am I getting chopped up? If I've had 10 losing trades in a row, maybe that algorithm was trading during a time when the market was sideways and just eating itself up, right? So that's where risk management comes in, is just being able to read all that and all that data. So now we get to what for us here at the Independent Quant is the next core principle for quantitative trading, which is automation and algorithmic execution, right? So now I've developed this algorithm that can read market data, and I've gotten it optimized to the point where it's profitable. It's been profitable for the last several weeks. Now I take that into validation first, which is I'm going to take that algorithm and place it to trade in simulation. Most platforms allow you to do this. I do this with NinjaTrader. You can run the algorithm and see how it actually performs with live data. And what I found was that I had a loser as an algorithm. And I was like, okay, but I backtested it and it worked. Well, when I looked deeper, I failed to account for, and this is exactly why you want to sim trade any strategy before you take it live. I forgot to account for that in backtest. When NinjaTrader does its calculations, it does it using the open, high, low, and close of each one of the bars that it's using, not tick data. While in one that's using live data, be that in simulation or in live, it actually uses tick data. It uses every transaction that's happened and every price that happened at to make its calculations. So when I looked at the graph, because within the backtester, you can go in and see where the trades happen within the day graphically on a chart. I found that the VWAP looked nothing like the VWAP for the day and the live trading session. And that's because it was using the open, high, low, and close for each bar to calculate the VWAP, which is not how the VWAP is calculated live. So I took that into account, and I was able to retweak and optimize the strategy so that it actually turned back profitable in simulation. I haven't taken this live. Like I said, this is still something that's under development. It takes me a bit to get confident with a strategy before I take it live. And I did this with ES because after I see that, yes, it's a profitable strategy, now I have the option to take that strategy live. But the beauty about ES is, and doing it with NinjaTrader, this is not I'm not advocating for the use of NinjaTrader. Again, I'm not funded by them. It's, the margins are fairly low compared to other platforms because it's a discount brokerage. Now, on top of that, ES also has a micro, which is the MES, which requires even a fraction of the capital to do it. It's the same exact price action, same exact calculations. It's just you are risking less per trade. And that's going to eventually allow me now to take this strategy and run it on MES live using a very small account size to see if this is actually a profitable strategy when I take it live. The importance there is a simulation strategy is guessing as to what the actual fills are going to be. So you may have a profitable strategy, but when you take it live, it's actually not a profitable strategy because you wouldn't have been filled the way that you were getting filled in simulation. Ultimately, those are the big muscle movements of quant trading and the core principles. Like I said, it's being able to have that rule-based nature, using data to drive decision-making, which ultimately will be done by an algorithm, ability to backtest, the ability to manage your risk, and, like I said, automation. It's the greatest thing in the world for me, at least. I began trading because I didn't want to be in front of a computer. I wanted to make money passively using my own money. I didn't want to sit in front of a computer and have to do that, which is why I'm a swing trader. But now I'm, doubling down on all the algorithmic trading that I've been doing in the past and actually building a business based on algorithmic strategies. If that all sounds appealing to you, then please head on over to the Independent Quant, sign up for our newsletter. and keep in touch with us. We know we provide a lot of resources for you to get on and start building your own algorithmic trade desk, and follow me along as I do the same. Until next time, this is Luis. Keep it green. Thank you, everyone.